Do you want to learn how to actually read and understand any company's cash flow statement in 1 minute or less? Then you've come to the right place. Welcome to the CSuite network. I'll show you how it's done. On screen, I have 6 years worth of cash flow statements for our example company, Apple. Now, by far, the most important line on the entire cash flow statement is the total cash flow from operations line you see right here. Now, why is this line considered the most important line on the cash flow statement and, in Warren Buffett's opinion, the most important line on all the company's financial statements? The total cash flow from operations line tells you instantly whether the company can produce cash purely from its own business operations. Okay, it answers the question in black and white without any ambiguity or accounting trickery. Does the company generate cash? Not is it profitable, two different things, but does it generate cash? Which I would argue, and many would argue, is more important than first determining profitability. You can be profitable, but not generate any cash. And at that point, you're just a business that is existing, not growing. If a company cannot generate cash from its operations, then it cannot provide a return to its stockholders. It's as simple as that. If the total cash flow from operations line is positive for at least 5 years and is increasing, the answer to the question, does the company generate cash from operations, is yes, clear as day. This should be the first analysis you perform when determining any company's investability. Now, you don't have to take my word for it when investing. This is the line that Warren Buffett himself first looks at when determining whether he's going to continue or pursue an investment in this company, okay? It tells you about 90% about everything you need to know about the company. My name is Nelson Alvarez. I'm a CPA and executive management consultant. If you want to learn more, I go into much greater detail in my video linked here of Warren Buffett cash flow statement analysis, so check that out if you're interested. Continuing on, the next line item to look at is the total cash flow from investing activities. This total line indicates how much money the company is investing into itself and in its future operations. This line is typically negative for most companies because it indicates cash expenditures, right? The company is shelling out money, writing checks to purchase equipment, improve their supply chains, buy more software to optimize their products, okay? These are all cash expenditures, and they're investments in the company's ability to produce revenue currently and in the long run. Okay, you want to see a company investing in its future. You want to see these cash expenditures in the investing section. Now, what you do not want to see, is the cash outflow in the investing section net out against the cash inflow from operations, okay? Because on a net basis, that essentially means that the company brought in zero cash for the year. Think about it. My cash flow from operations is $10 million. Great. That's $10 million I plan on adding to my bank. However, my cash outflow from investing is actually negative $10 million because I use money during the year to buy equipment, to buy factories, to buy software, okay? So on a net basis, my cash inflow from operations nets out against the cash expenditures I put back into the company. So I'm essentially adding $0. You want to look at this trend over at least a period of 5+ years to really see where the company's flushing this out and where it's heading. Okay, general rule of thumb, make sure that cash inflows from operations are larger than the cash outflows from the investing section, because that will indicate that the company is not too reliant on its property, plant, and equipment and future-proofing in order to generate its revenues. And again, if you want to learn more, I go into much greater detail in the cash flow analysis video linked here. Lastly is your cash flow from financing section. This number, if positive, will indicate that the company had to take out loans and or issue stock in order to fund its operations. If this number is negative, it indicates that the company is paying back loans, buying back stock, or issuing dividends in order to provide that return to its investors. You generally and ideally want to see this number be negative over 5+ years because that indicates the company is buying back stock, issuing dividends, and paying back loans. If a company is doing this, it indicates that the company has strong cash flow from operations, a strong competitive advantage, and a strong management team, and overall provides a great return to its investors. Okay, high level, that's generally really it. You can use these tactics in about a minute or less to determine if a company is initially worth pursuing further investigation for an investment. I hope this video gave you a good primer on cash flow statement analysis. Again, if you want to learn more, check out the full-length video here. I go into much more detail. Hope to see you there.